think people are still funneling in, but we can get started. Okay. Hi, everyone. So we're super pleased to have Mario here on our founder speaker series. Mario is the CEO and co-founder of Oscar Health, as you probably know from the slide. Before we go into his impressive background, I wanted to share 2 minutes on Pair and how we work with founders. So Pair is an early stage fund based in Palo Alto. We're super hands-on, help early stage companies go from zero, the idea stage, which is pre-seed, I guess in the seed world, and 0.5, which is the product love stage, and then finally 1 where our products reach product market fit and we support them beyond. So hence the arrow on the right. We partner with founders in many ways. So we partner through our pitch competitions, our accelerator program. We're actually still accepting rolling applications this summer, but it's filling up quickly. So if anyone's interested, definitely apply. And then we also invest seed stage, ranging from 100K to 3 million. And I've had the pleasure of working with an amazing Pair team. Our team is growing. I had to update this slide today. Our Pair team is made up of 7 investment partners who have founded 8 companies and use their operating experience to help our founders with product and growth mentorship. We invested in early stage startups that are now worth over $40 billion. And that's not even updating with the DoorDash IPO. So I guess that number is outdated now. We also help portfolio companies with making their first early hires and fundraise post Series A. Okay. Great. And then we go on this journey with a lot of different industries: biotech, healthcare, consumer, enterprise, and fintech. And we also have a robust portfolio of leading healthcare and biotech companies. So, we partner with Recora, Axel Health. Those are a little bit seed stage. Our little bit later stage companies include obviously Garden Health, which has had an IPO, and BioAge and iXlayer. And we also host a lot of events such as these. So we actually have an event tonight on Clubhouse. So we started to join the Clubhouse frenzy, and we have a group called 0 to 1. So definitely join us there. And we'll be talking about marketplaces with our partner Anand and Sarah Tavel, a GP at Benchmark. And our guest will be Nick, who's our CEO of OfferUp. And then we also have an event end of this month with the CEO and co-founder of Databricks. And he'll talk about what it's like to go from a Berkeley startup to a $28 billion unicorn. So that should be a good event. Cool. So now back to Mario's impressive background. So Mario is the CEO and co-founder of Oscar, the first healthcare insurance company built around a full stack technology platform, and are relentlessly focused on serving their members. They're headquartered in New York City. Oscar has been challenging the healthcare system status quo since 2012 and now serves over 525,000 members across 18 states. They're also the 3rd largest for-profit national insurer in the individual market in the US based on membership, and have since expanded into small group and Medicare Advantage. And this is like all information on the website. So Mario, correct me if I'm saying anything wrong.
Sounds good.
And then prior to Oscar, Mario founded the largest social gaming company in LatAm. And he also worked at Bridgewater and McKinsey, and he was a visiting scholar at Stanford. I'm just listing all your accomplishments, and co-authored 10 computer science publications, including apparently one of the most cited computer science papers published in the past decade. And he holds a degree in computer science from University of Hannover in Germany, and MBA from Harvard Business School. And apparently went to business school with Margarita Galold, one of our marketing
partners. Right,
yeah. So it's good that you could see connections moving forward after business school. Great, so thank you so much for joining us. I guess our first question, and I'll stop sharing my screen so we can look at our faces. Our first question is, can you talk about sort of your early childhood and what inspired you sort of to, become a founder?
That's a great question. So I'm not sure there's anything that I didn't know for a long time I wanted to be a founder, frankly. In fact, actually, when I was at McKinsey, I'll tell that story first and I'll go back a little bit. When I was at McKinsey in 2004, we won a project in Amsterdam at the time, actually. And a lot of that team then went on a project in Brazil, in Rio de Janeiro, which is probably as nice a place as you can pick for McKinsey projects. And I decided to just tell McKinsey I'm going to take the summer off and go back to San Francisco to do another startup with a friend of mine who had written a bunch of computer science stuff at Stanford. Pedja knows him very well. Sepp Kamvar. That's actually the guy who originally introduced me to Pejman. That's how I know him.
Oh, wow.
Yeah, exactly. And so in 2004, we're sitting there, and Pejman actually, I think, was in the middle of this too, back in the days, starting over the summer a startup. And at the time, the idea was to create a company where you'd sort of be able to sell digital goods, so digital assets, and make some money in reselling them as well, which now is almost like coming back in the form of NFTs and things like that many years later. And I rented a very simple apartment in Market Street, and I slept on the floor, then would buy a mattress, really save money, be really frugal. And at the end of that summer, I remember calling one of my McKinsey buddies and said, "This was a great A/B test. I now know I never want to start a company again." Because they were sort of like living it up in Rio de Janeiro and a McKinsey project there, and it was a great success. And I was toiling away in a startup in this empty, dirty apartment basically, and not going anywhere. And obviously, it's not at all how it then evolved. I then went to business school, mostly so I could just start a couple of companies again, have 2 years to have time to do coding and programming and start a couple of things. And that's eventually sort of like what Oscar came out of, at least indirectly. So my point there is you just never really know. And in some level, picking the path with the most pain might be maybe then the end the one that's the best. Early childhoods, I got a Sinclair ZX81 computer, which had, I think,
wow.
0.5 kilobytes in RAM when I was 8 years old, and a couple of manuals came with that. My parents knew nothing about computers or mathematics or anything like that. Father's a middle school teacher in geography and music, and mother's a neonatal intensive care unit nurse, and just kind of started reading the manuals and picked up a little bit of coding there, and that's what got me into it. And then there's a kind of a famous nationwide competition in Germany called Jugendforscht, young people do research, like a really specific name, where in the mid-90s I built a system that allows the computers to like film your eye, basically find your pupil, and you could control the computer with your eye movements. And that really made me for the first time realize, oh, I can build stuff, and people will look at it and will want to use it and will get excited about it. And I met somebody at the competition who was talking about this is like before the first bubble even startups, and that's sort of what got me interested in it. But beyond that, it's really I think a path that led mostly through tinkering, wanting to build something interesting, and trying to figure out stuff that others couldn't figure out, as opposed to being driven by changing the world or making a lot of money or whatever else. I really came at this from the sort of like, there's an interesting problem I would like to solve, and I would like to tinker with it. And if something emerges from it, great. If not, then that's also fine.
Yeah, that's a really good perspective to have, and it sounds like a very more of a computer science technical founder perspective.
Yeah.
I'd love to talk about sort of, you mentioned briefly how that's how Oscar started when you were tinkering around. Can you talk about the inception of Oscar and how, I know Joshua Kushner is your co-founder. Like, did you start it with him in the beginning, or was it by yourself first? I'd love to hear like the actual, like what it was like day to day.
Yeah, the true story is that I started a couple of companies in business school, as I mentioned, and then one of them, the idea was to be a social network for Latin America. It's honestly like a pretty simple cultural arbitrage idea. Facebook had been taken off in the US, but wasn't in Latin America yet. So that was the idea there. That didn't go anywhere for a couple of years. I worked at Bridgewater, but I kept the servers running. And eventually I started like seeing several online games do well. This is even pre-Oscar still, right? I'm telling the kind of pre-story there. And that then made us pivot towards building online games. This is like 2009, 2010 or so. That really took off when that became a company we raised a bunch of money for. Pre-Oscar, where Josh was my co-founder already. And in gaming, the problem is always, it's difficult to create hits and have a kind of steady stream of hits there. This is a little bit before the casual game, mobile game revolution, but the paradigm shift towards mobile had already been happening. We didn't really make that successfully, and so I got fired from the company as a founder. I wasn't the CEO there, but I was sort of like the chief scientist was the title, overseeing the game development and the technology and so on. And I found myself back in New York. My wife was pregnant with our first kids. Not a super great position to be in, not have a job and fired from your own company and everything. Obviously, psychologically not easy to deal with. And so Josh and I had a coffee and both kind of licking our wounds, saying, what do we do next? He was already building his venture capital fund called Thrive Capital. and making the first investments there. And he said, I think we start a health insurance company. And he'd Spain his uncle at the time and was annoyed with the confusion he had in just navigating healthcare to begin with. And I really knew nothing at the time about either healthcare nor health insurance, but thought precisely because I knew nothing about it, others probably won't know very much about it either, at least from sort of like my ecosystem, right, in the technology more side in Silicon Valley and so on, broadly speaking. And that's why I thought, how would I deconstruct a health insurer? What are the components of a health insurance company? You need to pay claims, send bills, medically manage members, build a network of physicians and hospitals, and put that picture together, which was not that easy because, with it simply TechCrunch wasn't right about health insurance at the time, or even about insurance at all. It's like, make it very simple. In fact, actually, no, it's not entirely true. TechCrunch had at the time, not to dump on TechCrunch, right, but like using them as a metaphor for Silicon Valley speak. They were writing a little bit about healthcare, and I thought it was mostly pretty pointless because it had the Silicon Valley view on healthcare, which is buy an expensive gadget and it'll tell you, when you're going to die or whatever, as opposed to really, okay, there's $3 trillion. Where do they get made? Where do they get spent in healthcare? Really in the mechanics of it. And so was able to piece this together. We then, which is an interesting part of the story as well, got introduced to some people who had recently retired from or left New York-based kind of local health insurers. And they were then our expert witnesses, so to speak, and could really tell us how this works from the insides. And one thing about healthcare is that it's not an industry to this day where I think the best product or the best technology wins. It's still very local. It's still very relationship driven. It's still very driven very much by who's got the best enterprise sales force and things like that. And so having these kind of insiders there to marry what we knew about the technology we wanted to build with what does actually the mechanics really work was crucial. And so it went from there. And we were the first health insurer in New York State that got licensed from the ground up in, I think, 25 years or so. At the time, there was no category called insurtech that didn't really exist. We were the first insurance company that came in any way out of the technology startup space. And so that's where Oscar came from.
I guess my next question was to ask what the landscape looked like, but you answered that. There was no landscape.
Yeah, there wasn't really much of a landscape. No, and it's, yeah, and I mean, maybe more thing on the founder thing as well. I remember when we started Oscar that I thought this isn't what I do well at all. I thought it was going to be mostly about kind of piecing together vendors and relationships and getting hospital and physician contracts. And I didn't consider myself a person who was all that great at making those kind of connections or going out there. Anyhow, I think I was able to do it, I think, and overcome, I think, sort of like overcome myself there, which is another interesting way of challenging yourself when you start a company.
Can you talk about like how Oscar simplified the existing traditional market? I remember a lot of my friends who lived in New York just saw Oscar's like commercial, or I guess like Subway commercials everywhere. So that's how you guys sort of became more consumer focused. But I'm curious, like, how did you simplify healthcare back then, or even now?
The simple idea behind starting with an insurance company was that the insurance company controls all the incentives in healthcare, right? It pays the providers and it tells members what something will cost. And it has a lot of data visibility because insurers are the only ones in the US healthcare system who can see all of the claims go through the system, medical records and so on are all visible essentially to the insurance company. And so we thought that if we can get members to really say, when I need a physician, I'm going to go to Oscar first, I'm going to check there. That would enable us to have a lot more influence on how people get care, what it would cost them, and things like that. And everything we've been doing for the past 9 years has been building up towards that and building towards. And so, for example, when members look for a new physician under Oscar, it's a simple thing, but you go into a cardiologist for the first time or a primary care physician. In about 43% of those cases, Oscar will be, we will be the ones who recommend the physician to you, and you'll go there. That means we can bias you towards doctors where we know they're going to be more cost efficient and higher quality. On average, you'll save about 7% in that as you go through it. The most recent thing we've done is we were the first insurer, even back in 2014, that made telemedicine totally free. So in this case, mostly tele-urgent care. That's obviously now commonplace, but even pre-pandemic, it wasn't that commonplace. We've now followed up on this. We run our own medical group called the Oscar Medical Group. And so you can New York now, for example, pick a primary care physician in that medical group, and every care that that physician triggers will also be free for you. Obviously, the doctor care will be free, but also the downstream care will be free. And so that's a pretty big that's been a big additional shift towards making healthcare easier for you, more discoverable, and ultimately cheaper.
Yeah. And in terms of your offerings, I know I mentioned this earlier, you started out with individual health plans. Can you talk about sort of, the trajectory of like when you first started, why did you pick individual health plans, and how the ACA sort of propelled your growth in the early days?
I'd say it was a combination of two things. One is that it was a real entry window. The ACA got passed in 2010. In the middle of 2012, the Supreme Court really made the final reaffirmation, and we thought final, been relitigated a couple of times since then. And it launched in early 2000 for 1/1/2014. And so it enabled us to get into these markets in a credible way. We didn't have to somehow say, oh, we're now going to enter the employer market, which has already been around for decades and ever, and so on. It was a new market and tried the catalyst there. I think that looking for this kind of regulatory arbitrage is generally a good idea when it comes to entering industries where established players are around, because they often will have more trouble trying to, bite off these opportunities, or more awkwardness in doing that. The second piece really is the philosophy behind the products, meaning if we can engage you directly, we will have more influence over where you get care, and we'll use it to your advantage, and to make sure you save money and get higher quality outcomes. That's way more difficult in every other part of the US health insurance markets. But in individual, we can directly build relationships. And that is exactly, I think, what happens. And in my view, all of US healthcare will individualize in the next 10 years, but that's going to be the process that's still unfolding.
Can you talk a little bit about your view on the market individualizing? Is that like a common view, you would say, in your like industry, or is that more
I don't think it's a common view. It's a great question. I think the most profitable market for health insurers, and frankly anybody in US healthcare, is Medicare Advantage. That is where the government said about 15 years ago, hey, members who have Medicare from the government over 65 years old, they can pick a private health plan, and then they get some additional incentives and whatever to go get care and stuff like that, right? That's been extremely profitable for insurance companies and for providers taking risk and so on. Frankly, partly for the reason that MA plans like to say that they're reducing costs. The reality is that there's a mechanism that's very important in Medicare Advantage, whereby an insurance company can tell the governments, oh, this is a diabetic, and get paid more for that member than would otherwise been the case. And so the dirty secret of Medicare is that if the entire US Medicare patient base shifted to the Medicare Advantage, costs would instantly rise by 15% or so for the US healthcare system. It's not that costs would go down, because insurers would be better at finding who is a diabetic who just hasn't happened to tell, on a claim that that's actually the case, and that would drive the cost up there. So long story short, sorry, I'm digressing a little bit there. Long story short, MA is the most profitable market. That is already an individualized market. That is a market where every insurer and every market participant would say, hey, let's do more of that, right? And let's get more of that going. But the biggest bulk of the US insurance market is still the employer market. That's 150 million people or so. And there you have incredible entrenched interests, obviously, in not rocking the boat too much there. I think that is, frankly, the root of all evil in US healthcare. You have no, not to exaggerate, but what happens there is you have no pressure really on the cost side of things, on the value chain, neither on insurance companies nor on providers, because ultimately the employer bears the risk, and the employer is not going to be aggressive at some innovation on the healthcare side or cost management level, where that should be the case. So if you were buying your cell phones to your employer still, you probably wouldn't have an iPhone. It would be probably 5 times more expensive.
And on the other side, though, you see a lot of employers sort of getting pitched like benefits, healthcare benefits. What is your perspective on that side?
I think that's where the market is right now. And if I give my advice to companies in the space right now, the reality is that's where the money is, and where the business can get built. Companies like Livongo in Teladoc were extremely successful in selling to the employer. I mean, Teladoc. I mean, an investor described Teladoc once to me as saying, "I love the business because employers are paying for it and nobody's using it. So you get a very steady revenue stream, and you get no costs on the cost of goods sold, basically, on the other hand. It's obviously not that's not going to revolutionize healthcare, but it's a good business model in that sense. And I think it goes to the weakness of the employer market there. I think that employers have not been great aggregators of healthcare technology. I think the incentives are all kind of off in that regards. And I do think it'll shift over time, but it will take some time. And it'll, I think the more it happens, I think the better it is for healthcare and for startups in the space as well, because you create more of a consumer markets that I think most of the people on this conversation probably will understand better than the Byzantine. I got to call this broker in Nashville because he can get me an in with Coca-Cola or whatever.
Yeah, it's very makes sense. But, yeah, no, I saw Oscar just partner with Cigna to provide small business health insurance. So that kind of segueing into, I guess, moving beyond individual into Medicare and small businesses. I'd love to hear about sort of what it means for Oscar and your future growth.
Yeah, so that is us selling to small employers, which are generally employers under 50 employees. In California, it's actually under 100 employees. Often these employers still work very much almost like individuals, right? It's the founders making decisions. They don't really have a big HR department that's going to purchase healthcare services themselves and so on. So in that sense, it's compatible with our philosophy of really going towards the individual and getting that individual engagement there. We did this with Cigna because we think that we built a really great technology platform that all of our stuff runs on. So the virtual primary care, the plan designs, the $3 drug tier is a different way of how we pay for drugs in several states. All the care routing, all the kind of real-time messaging or real-time alerting we have on the clinical sides, all these things we basically built to manage healthcare risk well and longitudinally and with a good member experience. They're all built on a really powerful platform that we want to get into as many places as we can, and we want to get as much scale on as we can. And so that is sometimes easier to do it with a good partner like Cigna that has a network already built in a couple of the cities many of the cities we're in, where you can more easily load employers onto it. And so we, in this case, run all the operations and the member experience and so on. And then we share kind of responsibility for sales and marketing with Cigna, and Cigna has the network in there. And that's a really good way to leverage our technology and our platform.
Amazing. Yeah, that makes a lot of sense in terms of licensing your tech stack to other players and expanding in those types of markets. I'm curious, I think shifting back, because I know we jumped from sort of you founding Oscar to you, Oscar, today. In between the 8 years, I'd love to hear sort of what, for the people on the call that are like, starting their company, thinking about starting a company, can you talk about the process of discovering product market fit for Oscar in the early days? Now it makes a lot of sense, but like, what was it like back then when you were trying to figure out how to get your first users or first 100 users? Or consumers?
Yeah, no, it's a really interesting question. I mean, in some sense, the uphill battle we've always had is to redefine what people expect of a health insurance company. Right? It's not that somehow if you ask people, hey, what would be an innovative health insurance company, that most of them would not have said, oh, that's where I get my healthcare, that's where I get my tip, that's where I refill my drugs and things like that. So those are all things we basically did first. And it's not necessarily the first place you call to find a new physician either. I mean, you had a much lower mobile app download rates, whatever, for the big incumbents than you have for Oscar, much lower engagement generally. We have about 47% of members, of subscribers are on a monthly active user base, monthly active users. That's comparable to some of the kind of real next-gen primary care, tech-driven primary care practices. And then we're obviously the insurance company, right? So we've really kind of changed that narrative towards the members there. And that was the biggest question, I think, that we had early on. Would people want that, accept that? And how can we demonstrate, and what are the best product features to put into the product there to make that happen? Which is why I think having free virtual care as like a very simply explainable thing in there right away was powerful. We were the first to, give you actually a fitness tracker back in the days, and Misfits, when they still existed, to pay you $1 a day for walking. Now it's obviously all health kit driven, Google Fit driven, and so on. But even simple stuff like that was simple things we could point to and say, that's what Oscar does, and it's different. And then you could get the license to then also say, and we pay claims faster, and and the customer service is better, and we'll solve your problem in a better way, and we'll give you some cheaper drugs, if you follow our advice there, and stuff like that. Then you can come with the more complicated things. But always having a couple of simple things you can hang your hat on, I think, is important there. I really think that's the positioning of the company matters in a way as well. And we were the first ones back in 2014. I like to claim all these firsts, right? And it's really true in this case. There was an article about this as well at some points that put ads into the New York subway. The first technology startup that put ads in there. You previously had
now everyone's posting their
everyone ads. You had like Dr. Zismore, the pimple popper or whatever in there, and then it was basically Oscar, and that, as you said at the beginning, we talked before the live stream started, that still is on people's mind even nowadays. We haven't advertised there in a while because the brand position is strong and so on. But that also matters, just like showing up differently in this space. That's when people give you the license of then saying, I want to figure out more. But even on that point, and this would be the final point I'd make, is in a complicated industry as healthcare, you cannot kind of blow up all the existing relationships right from the get-go. That just doesn't work. One of the biggest, I'd say, pivots in the company's history has been that we thought initially we can sell everything online. Every Oscar will be mostly hioscar.com, whatever, and that's what we're going to enroll and stuff like that. And so we even had in the very first year when this started, and when healthcare.gov was kind of shaky, right, we actually downloaded all the plan information for other insurers in the markets, and we had like a comparison website that we clearly had like Oscar, whatever branded, but we showed you the other guys, we showed you us, and then we had a bit more better chance of highlighting where we are different, until the regulators told us, hey guys, maybe don't do that, and we took it out. Fair, obviously, right? It never really shifted that way. The brokers in these markets still play a really powerful role. In markets like Florida, where the ACA membership base is more the lower income ends, kind of just above Medicaid's, local brokers, local churches are very, very powerful enrollment channels. And there, it really, don't try to shortcut that by putting fancy, advertisement on billboards, whatever that looks, kind of New Yorkery or whatever else. There, you got to go to the source. And so we actually built software to manage the brokers and really adopted our pitch to them as well. A lot of brokers are Oscar members as well. That you got to also make sure you kind of create there as well.
Yeah. So yeah, it's a mix of making sure that you understand each local market. And I know we have a lot of questions. For those who are listening, I'm going to save them for 4:15, or I guess 1:15, wherever you are. But yeah, I'm not ignoring people. I can see them. So in terms of the early unit economics, I think a lot of tech companies, a lot of consumer healthcare companies are kind of balancing like sort of the cost of acquisition, especially in the early days. Talking about marketing in the subway. Now marketing is so expensive as so many players are going in. I'm curious, like, how did you overcome the unit economics, or like, how did you think about unit economics when you were acquiring users? Or how do you think, has it changed since the early days?
Yeah, it definitely has. I think, healthcare is interesting in that, certainly insurance is interesting that we are highly regulated. And so we can't just go in and in every market absolutely light money on fire from a medical law, and like obviously sell below costs, certainly on the medical loss ratio sides. And so in our case, we have steered towards, for the last couple of years, towards contribution margin positive. So if you add together medical loss ratio and variable costs in the markets, we make money with marginal members there. We haven't fully amortized our fixed costs, right? So we're still losing money on the insurance sides. But every marginal member sort of like adds to basically the pie then in a way that we start seeing the economics shift better and better towards where they should be. That's been an important focus for the past couple of years. In fact, we think about that very, very carefully, in particular in pricing. The insurance industry is weird in that we can price once a year. And so we really have to think about when we price in April, May for the next year. So we're pricing right now, actually, we already had the first kickoff for pricing season. Between now and June, we pick all of our prices. Those prices will become effective for the plan year 2022, and we don't know what the competition will price. There's a really complex optimization problem. And we really are very, very careful about where we place bets, where we want to push more towards profitability, where we want to take profits, and things like that. So that's definitely shifted, because early on it was just sort of like, hey, happy-go-lucky and get a bunch of membership there. I think insurance, the economics are a bit clearer, right? It's like it's clearer to see where the value is coming from. And so that's the other reason why we have to be always a bit more thoughtful about this. Now, in our case, I think the big upside continues to be that we have this record-breaking member engagements that is, again, much higher than any other insurance company has. How much more can we translate this into lower cost outcomes? That's going to be the next 5 or 10 years of Oscar, really. I think there's a lot more we are doing there, we can do there. That's the kind of core part of the thesis. But the way we look at the business is really manage the economics kind of responsibly in the way that's would kind of like just a normal insurance business, and then have that be the upside that we continue to earn into.
Speaking of sort of driving better outcomes in the next 10 years, given I'm curious what you think are the implications of Biden care as it shifts to become more value-based, as it's like a more of a timely question. Love to hear your perspective there.
I think it's very positive. I think for the overall healthcare for the American public. Let's start there. To give you some numbers, the original ACA enrollment expectations were, I think, 25 million people by 2016 or so. That never went higher than 15, 16 million, I think, in kind of 2016 at the peak, and then went as low as 11, 12 million in the more recent years. The market shrank for every one of the last 3 years. It grew for the first time going into 2020, so basically this year, 2021. And so that's already positive now that the market will almost certainly grow. And we have a chance of going back to these enrollment numbers and get people insured who are not right now uninsured, who never entered this market because it was still too expensive. Right? The issue is if you make more than $40,000 a year as an individual, you almost can't afford an ACA plan because you don't get a subsidy from the government anymore. And the plans have gotten pretty expensive, I think, in my view, overall. Biden care really gives you a lot more subsidization there and funds that in a great way. What I would love to, that's a short term, the next, I'd say 2 years or so, what I would love to see is that is then the leading indicator of further individualization we talked about earlier, that companies will just say, what am I in the business? I'm not in the business of like picking your cell phone, you know, I shouldn't be in the business of like whatever negotiating with insurance companies either. There should be a great transparent markets where you can build the kind of healthcare experience you want. It might be your physician giving you all your coverage. It might be a concierge doctor. It might be, you know, an insurance company. It might be a hospital, whatever, all of the above. But that's what you're going to get. And then those players will be really motivated to serve you really well and lower your costs and improve your outcomes. That's what I'm hoping it will lead to.
That's great. I know I have a lot of questions, so I guess I have one more for more of the entrepreneur or someone who is working in startups. I'm curious, like, what advice you have for founders early in their 0 to 1 journey. Obviously, you've built Oscar from 0 to IPO. Would love to hear sort of the early days, if you have any pieces of advice for those on the call.
Yeah, I mean, probably too many to fit into a short conversation. I mean, I'd say 2 things that I think I would do differently, perhaps in hindsight. One is on the personnel side. I mean, hiring, everybody will tell you, is super important. I think many people will tell you this, and I would emphasize that hiring is also very important. The old saying goes, "I've never fired somebody too early," and that is very likely the case. If you have doubts we've had cases where we really had doubts that the person will make it or will be able to rally against it. And sometimes it's really is a question of just sort of like job fits. At different positions, suddenly the person completely lights up and changes the way they operate in a great way. But if you have more fundamental doubts, then it's just better to move on earlier rather than later. And I think that's incredibly important. I, for a long time, was very afraid of, let's say, executive team instability. Oh shit, like what if I lose the CTO? What if I lose the whatever? And the reality is, as Josh McGovern likes to say, the world doesn't end that often. You will just learn this when you go through the motions. No departure will ever be fatal for the company, including your own, frankly, as a founder CEO. As something to keep in mind as well. And it's really important to just be fairly dispassionate. Passionate about the people, of course, but dispassionate about the fallout of it. It's just not worth the keeping that together if it doesn't work. The second thing I would say, and it actually kind of blends into the first one a little bit, it really is to don't believe your own bullshits. There's an unbelievable amount of things where you will tell yourself, we'll get this done more quickly, we'll get this done in half the time. So it will just not happen. In healthcare, oftentimes I sort of like to say there's kind of two S curves, and that I observe with Oscar. It's hard to get into it, it's very complicated, but then you go up an S curve very quickly. Because almost this might be a little bit different now because there's a lot more capital in the system now, but it used to be the case. Let's take any other regular industry. Any Excel spreadsheet hack you deploy, the guy next to you probably didn't do it because it's a boring old insurance company. So you tell yourself, wow, I'm moving up the curve so quickly. Like we built our first reward system in like 5 weeks, whatever, and hacky and whatever, and broke all the time, but it was there. Then you go on a very, very long plateau where you rebuild your systems for real. And then I think you can kind of get that second wave of really then iterating quickly and having a great foundation on which you can build and stuff like that. In that phase, don't underestimate that plateau and the own your own bullshit thing. That applies to people as well. I think almost every startup founder will look at their people and say, wow, this is like an absolute killer team. Like United Healthcare or Goldman Sachs, they will never be able to hire, they would never work there, these people. We can just solve this by having smarter people. That is just delusion, I think. Yes, you can do more with a lot more smart people and with great passion and so on, but money goes a pretty long way, and incumbency power and so on goes a pretty long way. So you have to really say, where do I have a real advantage? Where can I press it? How can I maybe use where I'm successfully able to get hype with others? Definitely also use that, right? Tailwinds. But the don't believe your own bullshit, I think, is a really important thing. And by the way, the problem is if you take that too seriously, you will not start a company. That's the other thing. I often think I have a strong capacity for self-delusion, and it actually swings both ways. It's sort of like, oh, we can do everything, and then I'm also like, oh, we can do nothing. And it's neither one is correct, certainly. And you just got to sort of make sure you steer this in a good way, and that's going to be asked of you as a founder and CEO.
Yeah, I guess like follow up to that, it's really impressive to see, you go from starting the company to becoming the CEO as it's becoming a public company, or it is a public company. I'm curious, like, what is it like personally in your journey? Like, what is it like to be here today and to have been through everything?
Yeah.
Big question.
Yeah, I think I have to think about this. I think it's nothing ever gets easier, put it this way. Your problems will not get solved by the next thing you do, and your life will not get easier by the next milestone you reach. Your company will not get any less complicated. I think the number of companies that haven't had their stock price fall or whatever, or that haven't had I don't know, the co-founder quit or whatever else, or haven't had some other blow up, is like unbelievably minuscule.
Yeah.
I remember talking to Salar, the guy on the Google, who's employee number 9 at Google, and who's now aboard. And I asked him, "Hey Salar, how was Google like? Were you guys ever worrying about going out of business?" He's like, "No." And so Google might be the only one, and maybe some others that sort of like work that way. Everybody else has had absolutely miserable periods of gut wrenching, close to failure, I think, experience. that will keep coming, right? And so from my vantage points, nothing has gotten easier, I think. You always set the bar again higher, even though I think as a company, we've clearly gotten way better at absolutely everything. And will yet get much better at everything we're doing. So I'm extremely like confident, and I'm like, there's a rational part of me that says like, wow, we've built a lot of stuff and it's powerful and everything. But from an emotional point of view, you get used to just kind of always worrying about when will the next thing blow up and the next kind of thing not go in the way that you want it to be the case. And that will just, I don't think will ever change. And that's why if you're looking for that in your founder's journey, I would just tell you right now, you're not going to find it. And so you better stop looking for it, right? That's the only way you can do it. The only way is to detach yourself from that reality a little bit and say, yep, that's me being emotional about the fact that this is a just lonely, or not even lonely, it's nice to have a team around you, of course, but like just a crazy thing and everything, and that we're probably going to blow up and that it's not going to go well, right? As you go through all this thing, while really saying, but it's still the coolest thing I could do, and I'm pumped no matter what happens, and so on. I can tell, maybe one last word for me. When I got fired from the previous company, and I started I said, what do I do next? I said, I'm going to write down now when I start a task, when I finish a task, just so I can police myself and being more focused, not kind of go watch Game of Thrones all the time, whatever. And I started, so I've been doing this for like the last 10 years, basically, writing down what I do on a kind of minute by minute basis. And so I started eventually adding mood behind it as well. On a scale of 1 to 10, how do I feel? And that's very instructive. That's a 10-year data set now about myself. And what I know is that, yes, these gut punches from, oh, the competition did something smart. Oh, we're losing money over here. Oh, this member this didn't work, whatever. And they really dropped down the curve. But really in the biggest crisis moments, often my mood went up a lot, because then you realize like we can rally, we're in this, we can get through it. And so that's just what I would tell people. You got to look for the bounce back there, not for the bounce down.
That's super helpful and inspiring. Thank you. Okay, so now we have a lot of questions. So I think we'll try to pick a couple because you have great answers for all of them. I don't think we can go through all 30 questions. I guess the one broader one, and coming from our team, is what does Oscar look like in 10 years? I know you mentioned little bits and pieces, but we'd love to hear your thoughts there.
Oscar in 10 years. Yeah, I've always kind of, to myself, from an engineering perspective, simplified Oscar as we should know the most about who you are, both from your healthcare background perspective, from the chronic needs you have, and also from what you respond to. You respond to nice words, to incentives, to your relatives telling you things, your friends telling you things, and so on. And we should put that together in a kind of longitudinal, multi-decade view of what you best do to stay healthiest the longest, and frankly have the least cost in the healthcare system as a result. And then we should be kind of working backwards from that and saying, what are the incentives and the care that you should receive throughout that journey the next 40 years? That, in my view, is what Oscar is. It's kind of an engine to generate the right incentives matched against the right care personalized for you. And so everything else is sort of like a function of that. So we have to have doctors who then deliver the care for you. We can ship you drugs, whatever, to make sure that happens, and so on. That's, I think, in 10 years from now, we'll be doing much more of that, and we'll do part of it for our own insurance business with our own brands, and we'll do part of it as an engine for others, because I think that's the number of people in healthcare who want to take risk on outcomes will keep going up, and I think we can really enable people to do that in a great way through our platform.
Awesome, great. And then the next question is, if the healthcare market in the US is moving towards individual healthcare products, do you think there should be still a role for private insurers? And if not, what does that mean for Oscar?
Yeah, that's always a great question. I'd say that the best healthcare systems in the world are not single payer systems. They're systems where you have private payers. Singapore often gets mentioned, Switzerland often gets mentioned. And I think that's my opinion as well. I come from Germany, so I will have naturally a more socialist worldview in a sense. But I really do think that innovation in healthcare is really important. I think that people really respond to incentives, and that I think if you pay people for outcomes, they will perform better and operate better and more responsibly and so on. And I don't see how you can get them to the system with the governments like running one big health insurance plan. I just don't see it. All these systems I just mentioned all have universal coverage. We don't need single payer to get universal coverage. Even Biden care could get there, but you probably need a little more than that. So yes, I absolutely think private players need to be in healthcare. It'll make for a better system. But the problem with the US market is it's the worst of both worlds. It's neither a free market. It pretends a free market to be a free market when nobody has free market choices. And that's a very, very bad place to be. That's why it's so expensive and bad.
Great. And then we have some questions about cost of care. So I'll kind of combine them. So someone asks us, is Oscar been actually controlling cost of care and overuse of diagnostics? And then another is, how does Oscar handle high cost claimants? And are there any innovations on the stop-loss front?
Yeah, wow, that's a very in the weeds question. Good. So yes, we think we've been able to control the cost of care. I mean, the medical loss ratio is down, 30 points or so in the last 3-4 years or so. So it's been on a really clear path there of reducing that. And that goes, if you really do the math properly, that goes above and beyond the trend in the markets. And there's a certain trend in individual markets. We've been able to reduce the MLR by more points there than what that trend is, if you take into account how much we raised rates in the meantime and stuff like that. So we've been clearly taken medical loss ratio points out. Where we see that happen concretely is, for example, we even something as simple as we message you when you search for emergency room in the website, and if you have an anxiety condition, because we know then you have about a 30% positive predictive value of going to the ER in the next kind of 48 hours or so. That message reduces ER utilization subsequently by about 13% if you kind of adjust for a bunch of other factors. That's very, very simple, but it does the trick. We've been able to shift people more towards what we call good fills, drugs on the formulary that we think are the most cost efficient for what they do in our virtual primary care practice, in other things like that. Again, I think there's a ton of more of this that we can get in the next couple of years, but the tools and the technology, I think, is there for us to now very, very quickly test campaigns, test outreach, see the overutilization, things like that. And kind of goes to our technology chops as well. I could go in now and write a little query. In a language we built ourselves, basically a little domain-specific language that would very quickly let me normalize utilization costs and so on, and look at, in San Antonio, do we have an overutilization on the costs among 45-year-olds and up, whatever, of a certain facility. And that is a click of a button, real-time kind of thing. That is all directly in our systems. And I could combine this with what about members who, I don't know, had a telemedicine last week, or who looked for a cardiologist. That's all basically the same data lake and can be easily accessed there.
Awesome. That sounds very high tech and analytical.
And the other questions, I just realized there was one about stop loss and some.
Oh, yeah, I was just asking about innovations on the stop loss front.
Yeah. Actually, maybe one thing I'd say that surprised me, which is we have so-called quota share reinsurance. Okay, that it might be useful for some of the founders on the phone here, right? The more you will take dollar risk in healthcare, you will at some point have to post reserve capital. That is an inefficient use of venture capital to raise money at a whatever high cost of capital and park in bank accounts. We have to do this as an insurance company. What we did is we reinsured some of this, and that means the reinsurer takes some of that risk, and the regulators allow us to hold less in reserve, the reinsurers to hold the reserves. We thought that was a brilliant financial kind of engineering innovation, and I think it actually is. But I found it amazing how our IPO process, people just don't understand it. It's absolutely blew my mind how analysts and so on, look at different revenue figures there, and that is really interesting because it's on some level means that this, I think, is an important tool to some degree in certain situations for founders to move risk elsewhere and reduce their own cost of capital. But I think it needs to get a bit more airtime in healthcare as startups start taking more risk and so on. So if you want to learn more about reinsurance, we'd be happy to be of advice to you there, help to you there.
Okay, Thank you. There's so many questions. Let's see. I mean, I guess because of your German background, people keep asking if Oscar's model can be applied in other countries. So
I think it certainly can. I mean, absolutely. The idea of having the entity that takes the risk also be the entity that routes your care and even delivers your care, that is totally applicable elsewhere. Every insurance company in the world, and I honestly do think we had something to do with that, because many of them call us, is now really saying, I got to digitize, I got to have great member experience and all that kind of stuff. I mean, that's been a trend now for the past 3 or 4 years, not that much longer, I think. I think for advice for the startup crowd here, it is interesting how, I mean, the US healthcare market is basically as big as all other healthcare markets combined. So that is very fascinating. There is maybe one more trend I can share. Some of the Oscars in other countries, the kind of insurance startups, what they have done a little bit like us now in the US as well, is they've gone more quickly to other countries to platformize their technology. And so that actually is something you can maybe do better in other countries if you're not US based primarily, and sort of like going into the country that way. But anyhow, for us, the US is a massive market still, and we're happy here.
Yeah. Okay, last question. So from one of our pair founders, actually. So they ask, how did Oscar approach building out its provider base in the early days? And how did you gain the trust of physicians and health systems?
In the very early days, we rented a network of physicians and hospitals. And this was one of these things. I mentioned the ex-insurance company guys that we had early on. That was something that they brought to us, basically. They knew there's a network in New York City that union-backed plans rented oftentimes. And we went to them and we rented that network. And so that was, I think, very necessary early on. But then we started building our own narrow network designs. And I sort of, even with that first network, I did a bunch of data science that let us reduce networks by about 15% and cut out doctors who we thought were inefficient based on claims that we had been able to acquire and look through all that. So all these early queries and logic, whatever, that was all really me in the first set of data science at Oscar. Then we started building our own networks. And you know, the biggest thing I'd tell you there is what I do think still makes me very unique. I really think that's the case, is I do all my demos myself. So no matter whether I meet with regulators or with hospital CEOs, and I did this literally last week and the week before and the week before that, I spent an hour showing the products in my own app, in my Oscar accounts. It's got some kind of demo data in it that, you know, you can't quite tell what is my whatever, you know, drug versus what somebody else's. But I think that's a really powerful thing. And I used to have a demo even where I would reconfigure our claim system on the fly. Like literally I would go into a terminal in Mac and I would run a scripts and I would edit in VI, literally like a little configuration file, rerun the thing. And that really blew people's minds because they're not used to seeing that, one. So you stand out right away. It shows, it's the best way of showing that you really are a technology company. You have different technology. Everyone will right now sound the same. From Anthem to Cigna, they will all tell you something about their AI and the machine learning or whatever. And they all could have done that 10 years ago. And then now they're like, you know, here. And so that is just the best way to show is, oh, let me reconfigure the claim system. And the third thing is people know you have a different culture and they will want to buy into that partnership. That's the other thing.
That's awesome. It's good to know that you are still the salesperson.
Yeah, it's kind of that. It's true. And it pretend to be the chief scientist.
Awesome. Cool. I think we're basically at time. I know there are a couple other questions. I'm happy to try to answer them offline later on. You can email